and they chose to move forward with us for $75,000 with the 100% prepayment discount addendum. David mentioned this the other day, but they accepted the offer. They took the 75, and that was on December the 23rd. All right, can we see that well?
Yes, we can.
Okay, guys, I want to talk to you today about prepayment discounts versus prepayment penalties. What are they? How are they taken advantage of from our clients? And these are not quote unquote business loans or advances. They're fundings based on revenue. We're revenue-based funding. And in the context of advances and funding, also it can be known as merchant cash advances. But there are prepaid discounts and there are prepaid penalties, and they're different depending on what the financial company, the lender, uses them for. So what I want to basically go through with you guys is the difference between the two. First, let's talk about prepayment discounts. What are they? By definition, prepayment discounts are incentives that are offered to the merchants who choose to pay off their advance funding early. When a merchant repays the advance before the agreed upon term, they may receive a discount on the total amount owed. So these are all upfront prepayment discounts added to their agreement, and if they pay it off early, they're gonna get some type of discount for doing so. The purpose of it is designed to encourage early repayment, allowing the merchant to save on the overall cost of what the advance is. The discount is typically calculated based on the remaining balance or the total repayment amount. So, as an example, if a merchant has a funding of $100,000, but the total repayment is 130 over the next year, or whatever that date is, and they decide, hey, I want to pay this off early. What can I save? They might be offered a prepayment discount in their agreement that can reduce that total to about 115 that they would pay back. So they'd save about $15,000 in that particular scenario. Lenders want to offer all these to encourage folks not to go to the entire length of the term, but if they will pay it off early, they're going to give them incentives to do that. And then you have what's called prepayment penalties. By definition, prepayment penalties are fees or charges that are imposed on merchants who repay their advance funding early. This is often done to compensate the lender for the lost revenue that would have been generated from the interest or fees over the full term of the advance. The purpose is lenders may impose these penalties to discourage early prepayment, as it can affect the cash flow and profitability of the whole deal. The penalty is typically a percentage of the remaining balance or a fixed fee like $2,500. For example, if a merchant had an advance of $100,000, they were going to be paying back $130,000. They may be asked to pay a 5% of the unpaid balance, a 5% penalty for paying it off early, or a flat fee of $2,500. But the thing about it is, no lender on the Bank Breezy platform will ever charge our clients a prepayment penalty for paying back the advance funding early. We don't deal with any of those lenders. There's a lot of them in the space that will charge a penalty for paying it off early. None of our lender partners do that. Prepayment discounts, the incentives for early prepayment that reduce the total amount owed, there we give everybody on, I would say 95% of the time, there is a prepayment discount schedule added to our agreements. Prepayment penalties, these fees for that, there are none of those. We don't do any prepayment penalties with any of the fundings that we take care of. The prepayment discounts offered by our lender partners range anywhere from 10% of the balance due all the way up to 100% prepayment discount offered to our select funding merchant advances. Understanding these terms is kind of crucial for merchants considering any type of advance or funding as they can significantly impact the overall cost of financing. To break it down, here's how they typically are. With our A lenders, they're going to have anywhere between a 20 to a 25% off the remaining cost of funds. What I mean by that, if you have 100,000, the cost of funds is 30,000, you got to pay back 130. You get anywhere from a 20 to a 25% discount off of that what's left owed on that 30,000, not off the principal, but off of what's left owed. Now, if the A lender happens to be one that's offering the select funding offers for us, then we have anywhere from 50 to 100% off of the remaining cost of funds. For example, that 100% program. If and it's only on select funded offers. If someone has let's say that use that same scenario of 100,000 and they're paying back 30, and a month or two down the road, they say, hey, listen, I want to go ahead and just pay this thing off. Well, they've only paid for the cost of funds through that period of time. And then the rest of the cost of funds that are left due, they're wiped out. They're waived because of that 100% discount. Now, our B and C lenders offer 6 to 12% of the total cost of funds. So here's an example of that. These are the B and C lenders are the paper that the A lenders don't want. Most of the B and C lenders offer. Let's just use this example of funding. Let's say with 25,000, the payback's 35.5. Well, that rate is a 142 rate. If you do your math, 25,000 times 1.42. So they're going to pay back, regardless of the term, $35,500. They're going to often get a 30, 60, 90-day prepayment discount if they pay that off early. So giving you an example, on a 30-day payoff, instead of a 142, what happens is, let's say they got a 12% discount, because usually it's like 12, 10, and 8. Sometimes it's 10, 8, and 6. It just depends on who the lender is. So what we would do is on that, let's say that they had that particular scenario and of this $35,500 deal, they pay it off in 30 days. What happens is the lender takes that 1.42, they'll subtract 12 points off of the 142 to make it a 130. Instead of the payback being 35.5, it's going to be 32.5. So in essence, the client's going to save about $3,000 on that scenario. So again, prepayment penalties mean that lenders are going to charge them for paying it off early. That really happens a lot, even with banks and other places. You got prepayment penalties, especially if you're doing equipment financing. They want you to go through the term, but we don't do any prepayment penalties with anyone on our platform. Secondly, prepayment discounts. That's a great incentive to get people to accept our terms. You have a competitive advantage out there because of the fact that we do offer up to 100% prepayment discounts. And when I might be a little bit higher on cost of funds, but I got 100% prepayment discount. When I'm going up against someone with 10 or 20% prepayment discount, they're always going to accept what we offer. It's better than a line of credit because you can basically, lines of credit that we offer, they're pretty high cost of funds. And typically much higher than what the cost of funds on what our A lender long-term funding would be. But when we are working with these folks, with our A lenders, we've got a big advantage over what our competitors are doing out there because we're going to be able to offer all these great discounts. If that same scenario on that A lender was not a select funding and it was a 25% discount, they can pay it off anytime they want. Whatever that remaining cost of funds, not the principal, but the cost of funds, they're going to get 20 to 25% off